Coming up on Market to Market, a hurricane-weary region is in the crosshairs of another storm. Gene editing gains Nobel recognition. The sheep industry searches for profit in uncertain times.
On the grain side to
And market analysis with Don Rose. Next.
With much risk management down here.
What's the most complex industry on Earth? It's not genetics, or meteorology, or logistics. It's a business that involves them all. It's farming. Thank you, farmers, from Pioneer.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, October 9 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. The COVID tide is rising, and the U.S. economy is trying to hang on as Election Day approaches, when Americans will decide if they want to stay the course or elect a new captain of the ship. The sea of economic uncertainty includes job recovery, the election, and stimulus negotiations. Food insecurity is a global problem, and this week 2 prizes were awarded involving those working on different ways to address the problem. The Nobel Peace Prize was awarded to the World Food Program on Friday. Earlier this week, a pair working on gene editing were recognized for their work. John Torpy has our news wrap-up.
Two scientists won the Nobel Prize in Chemistry this week for developing methods to edit genes on the molecular level, potentially bringing new tools to agriculture.
That this morning when I received
Emmanuel Charpentier of France and Jennifer Doudna of the United States used a method known as CRISPR. The work involves precision cuts in strands of DNA, enabling scientists to precisely alter the DNA of animals, plants, and microorganisms.
We began it back maybe 5 years ago with the vision of bringing genome editing to bear on problems facing humanity, whether they be in biomedicine or in agriculture.
As the U.S. economy recovers from COVID-19 related shutdowns earlier this year, Americans are buying more imported goods while demand for U.S. products remains weak. The U.S. trade deficit rose to just over $67 billion in August, the highest level in 14 years. The Commerce Department reports the gap between the products the United States sells and what it buys from other countries climbed almost 6% last month. So far this year, American soybeans helped push U.S. exports above $172 billion, but imports hit nearly $240 billion, led by purchases of crude oil, cars, and auto parts. Another hurricane warning has been issued for portions of the U.S. Gulf Coast as Hurricane Delta makes its way towards Louisiana. The 25th named storm of the Atlantic hurricane season and the 6th to take aim at the Pelican State is predicted to make landfall late Friday or early Saturday. Delta's path is similar to Hurricane Laura's, the Category 4 storm which, in late August, caused widespread destruction to areas in and around Lake Charles. Terminals along the 256 miles of the lower Mississippi River are in the gale's path, and severe damage could impact shipments of grain to markets overseas. The nearly 60 miles of Old Muddy between the port of Baton Rouge and the port of South Louisiana are responsible for over half of the corn and soybean exports for the nation. For Market to Market, I'm John Torpy.
As beef, pork, and chicken dominate the meat sector, they also prove to be vulnerable when points in the supply chain were severely impacted by COVID-19. Advocates for alternate species are seeing an opportunity that may give their industry new life. Colleen Bradford-Krantz reports in our cover story.
Colorado lamb feeder Jeff Hasbrook knew by the spring of 2020 that the producer-owned sheep processing plant in nearby Greeley was likely facing bankruptcy. 5 years after the group bought it. Within weeks, the outlook turned even bleaker for Hasbrook and the rest of the 145 shareholders of the Mountain States Rosin Company packing plant.
When COVID hit, it was pretty much a done deal just because we lost 50% of our sales, a lot of retail sales, food service, that type of stuff that we were supplying. So when that hit, it was pretty much, that was the writing on the wall, that we didn't have any other choice.
On July 24th, Mountain States Rosin closed and went into bankruptcy. The facility had been processing about 300,000 lambs a year, or about 20% of the nation's supply.
It was a big blow to all the membership. 144, 45 families representing probably 200 to 250,000 lambs. So it was kind of honestly like a mass panic. What are we going to do with our lambs now? Do we sell them? Do you have a place to harvest them?
Making matters worse was the fact that the lamb industry had deliberately boosted the supply of market-ready lambs for what was traditionally its biggest period of demand, a month-long stretch that includes Easter, Passover, and this year, Ramadan, the Islamic month-long period that includes fasting followed by community feast.
We were absolutely geared up. The single largest supply point of American lamb, we were loaded for essentially April, and that all shut down. It was turning trucks around and phone calls to the plants that if the truck isn't loaded, don't load it. I mean, there was at least 100,000 lambs that had to be worked through in that near term.
Western sheep producers turned to some of the remaining larger lamb packing plants in nearby Denver, as well as in California and Ohio. But with a tremendous supply of lambs ready for market, less packing capacity, and the drop in demand with restaurants closed, prices plummeted. Keeping lambs longer would have meant the older ones would have been categorized as mutton.
Slaughter lambs, they went from $1.60 a pound in late February, early March. By the end of April, they were at 85 cents to $1 a pound. Losses were anticipated to be $125 million at the farm ranch gate.
In the Midwest, where sheep producers often split sales between Western buyers, who tend to supply the restaurant industry, and Eastern buyers who tend to prefer smaller lambs for ethnic markets, the outlook wasn't quite so bad. Iowa Sheep Industry Association's Randall Voss says he shifted his sales to the East Coast, wanting to avoid feeding lambs longer for such low prices.
I'd say it hit a little bit worse out west than it did out east. Been on a couple conference calls between different state sheep associations, and the folks out west was not positive, But in general, if you take COVID out of it, we need more sheep. You look at the amount of imported lamb that comes in, I think a lot of people in Iowa, at least, that raise a significant number of sheep are very positive on the long-term outlook of the industry. But, short-term, obviously, there were some hiccups.
Hasbrook says a handful of Western producers with larger flocks banded together to reduce the amount of available lamb meat by having their lambs only partially processed and put into cold storage.
There was roughly, I would say, 26 to 30,000 lambs that were harvested, and that meat was put in the freezer at their expense. That really, really helped save the industry. Even though COVID was here, they made a big move, and they still own the majority of that meat today.
In Greeley, efforts to halt the bankruptcy-related purchase of the lamb processing plant by JBS USA had failed. After the sale, JBS began preparing the facility to handle cattle. But the region's lamb producers still had a reprieve of sorts.
Pleasantly surprised by August. We were much more current than everybody anticipated. We worked through the backlog of lambs, essentially, by Labor Day. And this past week, we had a brand new state-of-the-art plant open for lamb slaughter.
The Brush, Colorado plant, known as Colorado Lamb Processors, which opened on September 21st, could eventually process 6,000 or more lambs a week. Colorado Lamb does not break down the lamb carcasses for retail sale, though it may add that service in the future if necessary. Jeff Hasbrook and his relatives, who live in the Alt Colorado area, began a search for a facility that could take their animals all the way to retail cut. They found and bought a lamb processing plant nearly 800 miles south in San Angelo, Texas.
And we're just now in the process of, basically trying to get it up to speed. It's been 15 years since they've killed a lamb there, but we're putting it back together to make it a lamb plant. We hope to have it up and running by the end of November, early December. I'm thinking we're going to be more like that 4,000 or 5,000 headed a week type of a deal, so the capacity for that plant is there.
Orwick says the federal government's COVID-related support programs, which included lamb producers, likely saved more than one from bankruptcy. He says even though many are still struggling financially, he's optimistic about the future as lamb prices rebound and the 2 new plants come online.
I really believe we're in a better place than what all of us were thinking we would be at by September, October.
For Market to Market, I'm Colleen Bradford Krantz.
Next, the Market to Market report.
Another USDA report kept the market turning higher as drier weather and global demand ate through stocks of grain. For the week, December wheat gained 21 cents, while the nearby corn contract improved 16 cents. Dry weather in South America led to talk of a delayed crop. The November soybean contract leaped higher by 45 cents. December soybean meal strengthened $11.80 per ton. December cotton expanded $1.82 per hundredweight. In the dairy parlor, November Class 3 milk futures increased 44 cents. A mixed week in the livestock sector. December cattle improved $1.50. November feeders dropped $4.35. And the December lean hog contract rocketed up $4.63. In the currency markets, the U.S. dollar index fell 85 ticks. November crude oil bumped $3.64 per barrel higher. COMEX gold added $25.70 per ounce. And the Goldman Sachs Commodity Index jumped nearly 20 points to finish at 359.65. Joining us now to give us his insight is regular market analyst Don Rose. Hello, Don.
Well, Paul, glad to be back. Thank you.
We had a couple of reports, 2 in the last 2 weeks. Nothing special. They haven't done anything to the markets. Is it the report that's moving the market, or is there such underlying factors the reports just happen to come through? You can do an overlay of all of these if you want.
Well, I think when you look at it, when you look back, what's really happening is the carryout and the supplies that we have in the U.S. continue to get smaller report by report. The September report, the yield was less than the August report. The September stocks and all positions report was a surprise report. It's a dangerous report. They adjusted the last year's stocks by 205 million bushels. Soybeans, they adjusted downward 52 million. So you carry that over to today, and the report, it was another bit of a surprise. They adjusted the acres, not the harvested acres, but both of them. The harvested implant had 1 million acres on corn, 700,000 acres on soybeans. Basically, a lot of those acres out of the Dakotas that you're going to find out, North and South Dakota, were prevent plant acres that we should have probably found out about before. So from a producer vantage point, you would say, well, I've been selling grain maybe not the way I wanted to because of the reports. And anyway, when you look back at it, you would like to think maybe it's COVID, something else, but the USDA adjustments have been historically a bit surprising.
A lot of green on the charts during the week leading up to maybe a positioning of the reports, but you look at this, the wheat contract specifically, up more than $1.31 off the lows. We touched over $6. It's still dry in Russia and the Ukraine. Is it a drought in the Southern Plains? So again, I ask almost the exact same question. Is it a report, or is it the weather that's had more impact on wheat?
Well, I think it's a combination, but I think what's happened to the wheat market, to put it in perspective, we pushed up to 5-year highs. So, that's kind of historical. We took nearby Chicago over $6. But you know, all of these markets, Paul, it's not just one thing that happens, it builds on itself. The dryness, we had big stocks last year, we still have big stocks this year, but what we're afraid of is going forward, much like the corn and soybeans, our stocks are getting less in the future. We're under 900 million on a carryout on old crop. You know, next year you're probably going under 800 million in the U.S. But you know, what's the driver? Russia's the largest wheat exporter in the world. They're in a drought pattern, also into Ukraine, and you know, the U.S. Southern Plains is dry. So it's one of those that we continue to add risk premium to the market. Now on Friday, we didn't have that great a close. I mean, the world stocks were bigger. We're down a few cents, and charts look a little bit toppy. So you have to be a bit careful. You know, is all the bull news in? The funds are long, over 70,000 contracts of wheat. That's about the upper end of the range. So, you know, it's a mature market right now, short term.
Short term, all right. Corn market, again, another rally, 74.5 cents off the 320 contract low, 8-month high going into today, and then we still went higher. Is that market topped?
Well, you look at, you know, from an overall carryover standpoint, I think that's the key. You know, our carryout's down to 2.1, you know, just under 2.2 billion bushels. I think when you look at the report, I think the feeling is that the exports are probably too low yet. I mean, if you look at it, the government has China buying 7 million metric tons of corn. Well, they've already bought 12 million metric tons, so what is the issue? So that's 200 million. So I think that's part of the reason the corn market pushed up. The other thing is the producers are busy selling soybeans with the big inversion at the highest price in 3 years and still holding on to corn with the carry in the market. But the carry did shrink down to 13 cents between July. So, you know, your question on price, usually around a 2 billion bushel corn crop gives you a nearby price $3.90 to $4. Well, we're right in that range. So, you know, things can still change. They do. It's a fluid market. But with what we know today, a 2 billion bushel carryover, you're also kind of a bit on the mature side with one eye on South America, one eye on Russia, and China's buying underneath the market.
Be careful, you might turn into an economist with all those eyes like hands. Long-term corn, if you look down to the deferred months, March again, 13 cents up, a 3% gain. The question a lot of people are floating around there, is 4 going to be the first number for a lot of these contracts moving forward? And for how long? What are you hearing?
Well, you know, you're right. What's happened is, you know, once you hit 4 on one number, you kind of pull it up, and we're kind of pulling up from the back. July corn is up close to 410, and so it went 408.5. Then you have the May over 4. March is just under 4, and that's what's happening. And then D's on the up front. So the corn market still has a carry, but, you know, just opposite of the soybeans. So you know that historically what happens is as we run up, you run into South America and it stuffs us back year after year between that 410, 420, 430. So watch South America. Their production on corn next year is going to be up about 110 million bushels. Soybeans in Brazil is estimated to be up about 325 million. So the world is expanding, acres are up, they sell in dollars, they buy in their currency, so they got a big advantage, big profits going on right now. So fence row planting, you know, they probably need a dry drought to keep the market going to the upside.
Which is what they have seen a little bit when you flip over to the soybean contract and you start looking at factors there. Is China buying? Is this La Nina in South America? You read this week delayed planting as a possibility, pushing now until late February before that South American crop is available. So all of a sudden the U.S. has a little more time in the spotlight. You got yourself some factors. 1065 is what we finished today on the November contract. At a time we were up to 45-month highs, Don. I guess I asked 4 for corn. Is 11 possible for soybeans?
Well,
you've 11 up front.
You've got the good numbers, because when you have a carryout where we're at now, between 250 and 300 million, the range that you usually are in is 10 to 11. So we got up, you know, close to, you know, the $11 short of that. So you're in that range. You know, we can. These markets aren't an exact science, regardless of you know, what you sometimes want to believe. It's work in progress, and with what we know today, the carry out at 290, you know, 10 to 11 is a tough marker. You know, we do have a dry pattern in Brazil. We're not so concerned about that. They're close to the Amazon monsoon rains coming. But in a La Nina year, Argentina is supposed to go dry. That's our concern. And, you know, the U.S. Southern Plains is supposed to be dry. Well, they are. So keep your eye on the sky over there.
We had a question that came to us via Twitter. We know you love Twitter all the time. I know you're on it all the time. Not really. Timothy in Houston, Minnesota, the beautiful part of southeast Minnesota there. He's asking, with the low carryover, does it now look like we should store beans or still sell them up front? We hear all these stories of people selling off the combine right now.
Well, and there's a good reason, Paul. You know, so the answer is, you know, from a structural standpoint, does it make sense to carry soybeans from November to July, 8 months, and lose 20 cents? Earlier in the day, we got up to 34, 35 cents. So does that make sense to you economically? Not really. So, you know, your answer is, if you want to still have ownership of beans, there's better ways to do it. And also we're at, you know, 3+ year high. So selling off the combine's been popular, and it looks like it makes sense.
Real quick on cotton, that's an area you saw in the news piece earlier. They're getting ready to harvest and having to deal with yet another storm. We're right at that point of a breakout, higher or lower. What's the market, you know, what are you hearing?
Well, it continues to kind of push up. You know, the government's not saying to get overly wild. December cotton's up around 68. The government said the cash is 62. You know, the concern is that the bowls are open now, and we've got a hurricane coming through, so it's an issue. But it's probably up to China if they're going to step in and continue to buy. They're a big player, as we know, in all these markets right now, and so I would watch them. But respect the charts are also up at the top end.
All right, in the cattle market, we've seen a little bit of narrowing on basis, then widening, and then narrowing back. Up this week, but a little less dramatic than what we've seen in other markets. Is this thing, it's hanging around higher. Can it stay there?
Well, the cattle market's much like a lot of these markets. You know, we've been spending most of the time since early summer recovering from the COVID. We've been marching 2 steps up, 1 down. You know, all these markets have been doing the same type of thing, trying to get that premium back in. That's what we're doing in the cattle market. Cattle feedlots are finally making money, you know, break even somewhere 102 to 104, depending on what you have. So, you know, that's a good thing. We got a premium structure in the market. And, you know, it looks like that tough resistance on April's that 117 to 120. So we're at the bottom of that range. So feeders are coming to the market. Feedlots, the weights are, you know, big. We got feeders coming off the drought pasture and need to have the feedlots continue to move cattle.
Well, in the feedlots, it's hard to pencil out $4 corn if you have a feedlot right now. So what are their options?
Well, and that's the reason that the feeder cattle have been coming under pressure, along with the calf run is really starting to pick up and putting some pressure on it. So, you know, you're right. You know, it's all up to the break evens, and something has to happen. You know, as the corn goes up, either the feeders have to go down or the back months of fat cattle have to go up. So, been trying to put a little bit of premium in those back months. Is it going to be rewarded? That's the question mark. The government says all next year you're supposed to have an average of 114 for cash cattle.
Well, and we're also hoping for a 2021 where it's a little better in the hog market too. China continues to expand their herd. They need some of our meal or DDGs or whatever to feed that. Is that our biggest competition for the U.S. pork industry looking ahead to 2021? Is China, or is there something else?
Well, I think we have to be a little bit careful. Remember, it's been, you know, it's growing a beard on the African swine fever that they had. You know, it's going on, what, 2.5 years, something like that. So they're expanding, and not only in China, but in other countries also, Argentina, Australia even. So, you know, you have to be a little bit careful. You know, with all these markets, Paul, I want to back up just a little bit. And I think, you know, we got really pasted on all the commodities with COVID. And so when you're up at levels that are profitable, you know, you have to keep in the back of your mind, risk management makes some sense, if for nothing else, just because we haven't really solved the COVID yet. And when do we solve it? And do we get into a second wave? You know, as we're still in the first wave, Europe is starting to get into the second wave. So, you know, risk management first is to manage the risk.
So does that tell you to hold? Does that tell you to sell, or is that I got to play both sides?
I think you have to play both sides. I mean, we've got, premiums like you were on talking about the hogs. You're close to 60 or 82 in the summer months. So, those are profitable levels. You can do some risk management with, some tools, build some, up and down in the market, do some specific type of things for specific operations. But certainly you're at risk management levels on a lot of these commodities across the board.
Always a lot to think about, and we will ask you more questions. We have a good feed question when it comes to the livestock market and Market Plus. Don Rose, good to see you. Thank you so very much for your insight tonight.
Thank you, Paul.
That will do it for this installment of Market to Market. As I said, we will talk more in Market Plus, so you can join us there. Find that on our website of markettomarket.org. Facebook is one of the places we post photos and links to our stories, giving you a place to talk about rural America. It's not all about arguing. Give us a follow at Market to Market Show on Facebook. Next week, we'll learn more about this year's World Food Prize winner. Until then, thanks for watching and have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content.
What's the most complex industry on Earth? It's not genetics, or meteorology, or logistics. It's a business that involves them all. It's farming. Thank you, farmers, from Pioneer.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.